So popular crypto trading strategies. We'll begin with dollar cost averaging. Now, dollar cost averaging is also called constant dollar plan. Let's start this with an example. I and you start investing in Bitcoin. You buy $5,000 of Bitcoin all in one go today. You get around 0.115 Bitcoin probably. I spend the same amount, which is $5,000, averaging it over a period of few months, protecting myself against Bitcoin's volatility and using it to my favor. And my dear friend, I might end up owning more Bitcoin than you. So in this case, I'll be using dollar cost averaging. You divide up the total amount to be invested across a certain period, this to reduce the volatility of the market. The purchases occur regardless of the asset's price and at regular intervals. It's more or less like SIP, systematic investment plan. Investing one lump sum amount can be poorly timed with regard to asset pricing. Although, one important point to note here is that it works out favorably only if the asset rises in value over the period of time in question. Moving on to our next popular strategy, which is arbitrage. We've discussed this in our previous episodes as well. We'll just try to explain this again here. A strategy under which a trader buys crypto in one market and sells it in another. The difference between the buy and sell price is their profit or loss, which is known as spread. Now, owing to the difference in liquidity and trading volume, traders can find an opportunity to book profit. One quick hack for this is that you must open accounts on exchanges that have a large difference between the prices of the crypto that you are trading with. Next one, we have scalping. This involves using increased trading volumes to book profit. Although there is risk involved, a smart trader takes care of the margin requirement and other important rules to avoid any bad trading experiences. Scalpers, as they're called, analyze the crypto asset, past trends, volumes, and choose an entry and exit point within a day. Moving on to our last popular trading strategy that we're covering in this episode, it's called risk bucketing. Now, bucketing is basically portfolio diversification. You bucket different assets to achieve your financial goals in conjunction with tolerance for risk. But please don't confuse it with an unethical practice in stock market, which is also called bucketing, wherein a broker generates a profit by misleading their client about the execution of a particular trade. So what happens is the broker confirms that a requested trade has taken place without actually executing that order, and that's where their profit or loss lies. And it's also called dabba trading in India, and it's an unethical practice, so don't confuse it with that. Now we just take it to our guest to discuss this further. We have with us Ajit Khurana, crypto evangelist and expert, founder of Genesis Network, Rohas Nagpal, chief blockchain architect, Hi-Fi Blockchain. A very warm welcome to both of you. We'll begin with you, Mr. Khurana. What is your pick out of these four that we've discussed?
I will not talk about scalping because with the incidence of TDS, it may have become an impossibility. Arbitrage is fabulous in principle, but can be done very rarely and with small volumes. There is not a great opportunity available. It continues to be a very exciting one, but does not offer very large scale possibilities. I love averaging, dollar cost averaging or SIP or whatever name, because I don't know how to time the market. So this is the best way of doing it. Risk bucketing, while you rightly said it is like portfolio, it is like, you put so much money in FD, so much money in mutual funds, so much money in stock, so much money in crypto. But within each of these, you should say, I put so many in the large caps like Bitcoin, Ethereum, etc., and so many in small ones. So the two that I will swear by and never give up are the averaging, such as dollar cost averaging, as well as risk bucketing.
Okay, Rohas, your picks.
So I'm actually a blockchain developer and not really a trader or investor. So I go with the with the cryptos that I build on. So when I see a lot of clients coming to me to develop projects, I have to buy the underlying crypto because that is like my stock and trade. Every day I have to spend in that crypto because I'm building projects. And that's primarily today Ethereum and Binance Smart Chain. So I go with that approach. What am I building on? Let me only buy those cryptos.
Sure, you'll see the project and you see the model rather than the trading strategy of it. But Mr. Khurana, since you gave us quite an insight into all these, which strategy would you recommend to a beginner? Because a lot of beginners watch this show, and also since this market is opening up in India, which one strategy would you recommend to a beginner, Mr. Khurana?
I think that if you're an investor, which means you intend to buy and hold for at least some time, such as months, it is impossible to avoid the dollar cost averaging strategy. You absolutely positively must do it. I would very strongly advise against not using this strategy. Risk marketing, desirable, but dollar cost averaging, absolutely necessary.
Okay, and I know, Rohas, you've clarified that you're not a trader, but would you recommend any of these to a beginner? Because you've, I think, for multiple times, you've actually talked about arbitrage on this very show as well. And
Exactly.
we've explained that to our viewers in the past. But would you recommend any one of these to a beginner?
As you correctly said, I would recommend arbitrage because that is one of the best ways to make money, because you are exploiting the inefficiency in the market. That every crypto in every exchange is not priced at the exact same amount. But I would like to say that you have to be very careful, because if you find an arbitrage opportunity in a low liquidity crypto, you may actually get stuck. You can only make money in arbitrage if you are going to buy and sell virtually in real time. So if you get stuck with a low liquidity crypto, you're stuck. Like if you remember, when there was a crypto ban rumor a few months ago, and suddenly there was a huge dip in the price of USDT versus INR, whereas the US dollar to INR was same. So a lot of people made huge money in that particular arbitrage. So wait for opportunities, and I would say arbitrage is the best way.
Where they bought crypto here and they sold at foreign exchanges.
That's correct. That's correct.
Right. Yeah, that's when I think we discuss arbitrage here as well. But Mr. Khurana, these are great, probably strategies on paper, but these can backfire if not done properly. So are there any tips that you would like to arm our viewers with?
Yes. So I will actually stick to just one of these because the discussion will become very long otherwise. The logic behind dollar cost averaging is that if you invest equal amounts of time over separate equal periods of time, what tends to happen is that when the price goes down, you buy more number of units. When the price goes up, you buy fewer number of units. So you get a better than average price. The average of 4 and 6 is 5, but you will get a better average than this. What tends to happen is that while this is a tool to remove emotions from the system, when the market is falling, people will shut down their dollar cost averaging, which means they'll stop their SIP like in the mutual fund. And what happens is that the lowest price ones, where they were going to get the most number of units, they're shut down because now they are panicking. And as a result, this will backfire because that means they will only buy when the market is high, which defeats the entire purpose of averaging.
Right. And of course, we're talking about traders here, but let's say I'm a beginner. I don't even get these strategies. Rohas, this question is for you. I don't get these strategies, let's say. What are the other tips that you would like to give this kind of audience who probably has not researched about these strategies or who doesn't get it, but there must be some tips for them before they go out to trade or invest?
Sure. I would say if you're absolutely new, then just look at one thing, which is called the Bitcoin Fear and Greed Index. So every day the index shows you whether the market right now is in fear or in greed. And it's a scale from 0 to 100. And without doubt, I can tell you, when it shows the market in extreme greed, that is the time to sell. When it shows extreme fear, that is the time to buy. Because when everyone is scared, everyone sells is when you get it at the cheapest price. And when everybody is greedy and saying it's going to go up, that's when you sell. And this applies primarily to Bitcoin. So I would say if you are very new and you are just starting with crypto, stick to only one, which is Bitcoin, and just use the fear and greed index as your guiding light. And I think you could do pretty well.
Sure. Thank you so very much, both of you, for talking to us.